Hope that all of you are fine. Can you
Good
hear me?
morning, sir. Yes, sir. Good morning, sir.
Yeah, morning. So I'm very happy to see you again in today's class. Today we have some important information for you
Good
because,
morning, sir.
yeah, morning. Good morning. So because from the next class, you are going to have your assessment started, your case study solution. You have to come up with the case study. Okay, so you will get 6 days to submit your case study before the next class starts. So today we'll be practicing during the class, and you have to be very attentive, and also you have to try by your own, to learn how to solve the financial case study. Okay. So before going to all this thing, I think not all students have arrived, only 23. The same problem happening every day. Okay. Okay, we can wait for maybe 4 or 5 minutes before we get the number of students as usual, because I'm going to assign you in a group. I'm going to assign you in a group.
Excuse me, sir. Hello, sir.
Yes, I'm listening.
Sir, can we make our own groups like for this case?
No. I will assign you in groups. Okay.
Okay, sir. What is the number of members in the group?
Many, because you have so many students. So there will be about 10 students in a group.
Okay, sir.
Some groups will have one extra, because I have seen that the number of students is 83. And the reason why I will assign you in the group is, actually you are BBA students, right? So our intention, our objective is to prepare you as a business executive or business manager, business administrator. So think about a real world business administration situation. Actually, you will have to work in a group. You have to make collaborative decision. You have to you have to solve problems collaboratively with other people. And how many of you will get the person of your choice in your organization? Will you get your person of your choice to make group decision, or to?
No, sir.
Yeah, actually you will not get. If you are lucky, you might get one or two. Okay, so that is the thing we want to replicate in your learning groups. Okay, so you will find that probably you are grouped with a completely different, a completely unknown person, maybe speaking a different language, may have a different cultural orientation. So this is the lesson you will learn from the group work. Okay, you will have to establish effective communication with people from different background, from diverse background. Okay, this is the intention, this is the reason we assign the teamwork to the students. So could I make it clear to you? Hello?
Yes, sir.
Yeah, so this is the reason actually. So any problem if I assign the groups for you?
No, sir.
Okay, so now take it as a challenge, knowing new people, establishing network with new people, having relationship with new people, and also motivating other people rather than having conflict. Even if there is a conflict, you have to know how to resolve the conflict, how to give priority to the achievement of the group work rather than personal conflict. Okay, so these are the things we will focus on, and also the case solution. So can you see the file that we actually made it ready in the last class?
Yes, sir.
Can you see it?
Yes, sir.
So this is from the textbook of our the finance textbook, and I have told you the page number, right? Let me find it out from the textbook. Then I will show both the textbook and the Excel file together. Okay. Can you see the both windows?
No, sir. Only one. Yes, sir.
Can you see now?
Yes, sir.
Okay. What we have done after discussing different other concepts related to Excel skills, okay, after that we have come to the financial statement and ratio analysis topic. So what we have done for giving the demonstration, classroom demonstration, I have actually keyed in the information, the financial statement, the balance sheet, and the income statement. Okay, the income statement from here, no, not this one, this one from here. So we have the income statement of 2015 and 2014. Okay, we have the income statement of 2015 and 2014. So and we have all the items: sales revenue, cost of goods sold, so and so, and at last we have the net income available for common stockholder. So that is the net income, and we have some additional calculation for both the years: amount of cash dividend, number of outstanding shares. So from there we have calculated earning per share and dividend per share. So all these are actually given in our textbook example, right? So now what we are going to do, that is the income statement. And also we have the balance sheet. The balance sheet from here, you can see the balance sheet is also given assets and liabilities and stockholders equity. So we have got all the assets, all the liabilities, and all the equity items. And we also have some extra calculation, extra information for both the years, right? So preferred stock par value, preferred stock dividend rate, preferred stock number, and common stock par value. All these are given. Okay, so that whenever we need these things, we can link to this cell. Okay, just like what we have done in our Excel exercises. So now, now we will learn how to estimate different types of ratios, All the discussions are in the textbook, which I'm going to discuss today. Okay, so there is a summary table, and we will follow the structure of the summary table to calculate the different financial ratios. So here is the summary table. Okay, let me reduce it. Can you see it even if I reduce? Can you see or not?
Yes, sir.
Students, can you hear me?
Yes, sir.
Hmm?
Yes, sir,
Yes,
you're
sir.
audible.
Hello? Can you hear
Yes,
me?
sir. We can hear you.
Okay, please be kind to me by answering whatever I ask. So let me rename the worksheet, because this worksheet contains the financial statements. Let me give a very short name so that we can remember. So I have given the name FS. You can also give the full name, financial statements. No problem. Nobody will stop you. Okay. Now, what we will do, we will try to calculate different types of ratios. You can see in this table, table 3.8, you can see that we have different classes of ratios. One is the liquidity ratio, another one is the activity ratio, another one is the debt ratio, another one is the profitability ratio, then market ratio. So before going to the calculation, let me try to give you some idea what is actually liquidity ratio. So you know liquidity, right? What is liquidity? Have you ever seen anything that is liquid? Anybody of you seen anything that is liquid? Probably none of you have seen any liquid thing, right?
This also.
Have you seen liquid, anything liquid in this world? Have you
Yes,
come
sir.
from another world or what?
No, sir. This one.
So what is the liquid thing that you have seen?
Water.
Water. Very simple. Okay. So what about Dutimala? Have you ever seen water?
Yes, sir.
Oh, great. So can you tell me what is the characteristic of water? What is the characteristic that every one of us know? Characteristic of water, the liquid matter.
It flows.
It flows. Excellent. Okay. So if I ask Jivan Sai, can you tell me? Oh, Jivan doesn't have any microphone anyway. So Omar, can you tell me? Uh, can you give any shape you want, to water? Can water be given any shape of your choice?
Yes, sir.
How? You have to put it inside that kind of shape. So it can take any form. That is the characteristic of water as a matter. So if I think about the financial world, in the financial world, we also have a liquid asset that is cash. Cash is like liquid because you can convert the cash into any asset you like. If you want to buy a motorbike, you can buy with cash. You can, if you want to buy an apartment, if you have cash, you can buy. If you have cash, you can buy what actually you cannot buy. Anything that you want to buy, you can buy if you have cash. So cash can be converted into any asset, just like the liquid matter. This is why we call it liquidity. So liquidity is very important for an organization because the business organizations need to pay different bills and need to pay the financial claims, from others. So the payment is usually done using cash. So the ability to generate sufficient amount of cash is very important. Okay, so to understand whether a company has sufficient liquidity or not, we have to calculate the liquidity ratios. We have two very well-known liquidity ratios. One is the current ratio and another one is the quick ratio. One is the current ratio and another one is the quick ratio. So from here you can actually understand. So what is the formula of current ratio? Current ratio is the name of the ratio. So you will understand what is current ratio from the formula. So can you see the formula? Who can tell me the formula of current ratio? Looking at the screen.
Current assets by
Divided by current
Yeah,
liabilities.
current asset over current
Divided.
liabilities. So mathematically, we can see that for $1 of liability, how many dollars of asset we have. Okay, that is called current ratio. Because you are dividing by current liability. You are dividing current asset by current liability. So the result will be for every dollar of liability, how much or how much dollar of how many dollars of asset you have. Okay, so this is the interpretation of current ratio. So for $1 of liability, that means you are supposed to pay $1. If you have only 50 cents of current asset, then that is a problem, because you might not be able to pay the liability using the 50 cents of current asset. You have to go to sell the fixed asset. But if you sell the fixed asset, you might not get the proper value quickly. It might also not be possible to sell the fixed asset very quickly. This is why liquidity ratio is very important. And normally the banks, the creditors, those who have given loan to the company, they will be interested about this ratio, liquidity ratio. Okay, and remember that liquidity, too low liquidity is bad. Definitely, as we have said, the company might not be able to pay the bills and also the financial obligations. And too high liquidity is also bad. Think about a company. If the company has so much of cash, idle cash, and very little of the fixed asset, then probably we can understand that the company could not invest much. So if the company cannot invest in different assets, then how can it make a good business? So liquidity ratio should not be too high, it should not be too low. So how can you decide whether the liquidity ratio of your company is good or not? Okay, actually you have to compare with the average of the industry. You have to look, let's say you are calculating the liquidity ratio of cement industry. So you have to see what other cement industries are maintaining. So if you get the industry average of all the cement companies in the industry, and then you can compare with that one. If your one is too deviated from the industry average, then you can say, well, if it is too low, you can say our liquidity is we have to improve our liquidity. If it is too high compared to the industry average, then you have to say, well, we have excess liquidity and we have to invest further. Okay, any question?
No, sir.
Okay, so what about activity ratio? Activity ratio similarly indicates whether the company, the business operations or the business activities are efficient or not. The inventory turnover indicates whether you are able to use your inventory more and more times. Average collection period indicates how many days you take to collect your receivable. For example, you have sold on credit, so you have to collect it very quickly, as quickly as possible, because if you collect the money, you can do another business. Okay, so this one you should the average collection period should be higher or lower. Which one is good? Higher one is good or lower one is good? If the average collection period is higher, what does it mean? You are taking more days for doing what? For doing what?
Sir, can you repeat the question once?
Vanilla? Sujit? Sujit will not respond. Santosh? What do you think? If the average collection period is 43.9 days, so this is the number of days for doing what? If you cannot understand, just let me know that I do not understand. There is no harm, because you are a student. Students will not understand. This is why they are students. So why do you feel shy saying that I am not understanding?
Sir, can you repeat the question once?
The question is, if the average collection period is 43.9 days, so what does it mean actually? It means the company is collecting the accounts receivable in how many days?
43 days, it means.
43 days. So is it good or bad? Depends on whether the number of days is high or low. At first, let me know, do you know what is accounts receivable?
Yes, sir.
What is accounts receivable?
Sales receivable.
Okay, when does accounts receivable arise?
When you sell a product, you,
On cash?
yes,
When you sell products on
Credit.
credit.
On credit. So after selling on credit, what do you need to do? You need to collect the money, or you just keep quiet? Which one?
collect the money.
Collect the
Collect
money.
the money. So which one is better, collecting quicker or collecting later?
Quicker.
Quicker, not slow, right? So the average collection period indicates that how many days on an average you take to collect your money from the customer. Similarly, average payment period is also the same. How many days you take to pay your supplier. So what do you think? Average payment period should be higher or lower? Which one is good?
Should be higher, I think, sir.
Should be higher, because you are paying other people's money. So the later you pay, the better you are, because you can use that supplier's money in your business. Okay. Similarly, total asset turnover. Total asset turnover indicates the sales generated from every dollar of asset. So the more sale you can generate, the better it is. So it should be higher. Okay. Again, debt ratio indicates the financial leverage. Debt ratio indicates the financial leverage. Okay, the more you borrow, the more you take loan, the more is the debt ratio. Okay, and that is not good. It should not be too high. Similarly, it should not be too low. A company should have some borrowing, because if you borrow, you just pay the fixed amount, but you can make a lot of profit out of it, which will go to the owner. But if your business is in trouble, you should not borrow. Or if you have already borrowed too much, you should not borrow. So this is also debt ratio should not be too low. It should also not be too high. Times interest earned ratio. This is the indication that for every dollar of interest, how much earning before interest and tax you have. So for every dollar of interest, the more you have this one, the more is your ability to pay. Okay, ability to pay the lender. For example, you have taken loan from the bank, so you will repay the interest from your profit, right? EBIT is the operating profit. This is the EBIT. So if you have $10 of interest spending, and if your EBIT is only $2, how can you pay the interest? Because your profit is only $2. Then what you will have to do? You will have to pay from your savings. So this is why times interest earned ratio should be higher. Okay, the higher, the better. Actually, fixed payment coverage ratio is another version of times interest earned ratio. If you have lease payment and other things, preferred dividend, all this thing. Okay, profitability. I think all of you understand what is profitability. Who can tell me what is profitability? Ability to make a loss.
Generate profit.
Ability to make profit, right? So profitability ratio. So we have several profit. So you understand that these ratios indicate how much profit a business organization can make. Okay, during your case study and presentation, you will have to interpret all these things. Okay, so you have to understand, and if you do not understand, you have to ask me. You have to say that I'm not understanding this thing. If you just keep quiet and later you cannot present, then you are not going to get the mark. So that is one thing. And another thing is, only getting mark is not the intention. You have to develop yourself for your future success. Okay, so profitability, you understand that it will indicate the ability to generate profit. Okay, so we have several versions: gross profit margin, operating profit margin, net profit margin. Gross profit margin indicates how much gross profit your organization can make after deducting the cost of goods sold. You see how do you get gross profit? From sales, you just deduct the cost of production, nothing else. Then operating profit margin. This is the EBIT. Operating profit is also called EBIT. So this is operating profit divided by sales. So compared to sales, if you generate high operating profit, this ratio will be higher. Net profit margin, this one, after deducting everything. Sorry, this one. After deducting everything, how much? Okay, the last one, sorry. After deducting everything, how much net profit is there compared to the sales? Okay, so the higher all this profitability, the better it is. earning per share, we have already calculated it. For every shareholder, how much you have. Okay, return on asset. So previously we have compared these profits with sales. Now we are comparing with asset. Okay, how much profit you can generate compared to asset. The return on equity, how much profit you can generate compared to the owner's investment, the equity. Okay, these are the profitability ratios. Now another one, which is market ratio. So market ratio is basically the share market ratio. Okay, if the share of your company is sold in the market, you have to collect the share price. Okay, you have to collect the share price. So you can see the market price per share at the end of 2014 was 18.06. This is given. Probably we have not got this information here. So let us write it down. Market price per share at the end of year, because our financial statements are at the end of year. So in 2014 it was 18.06. Okay, and in 2015 we don't know yet. We will see. Probably let us see. It will be inside the. Okay. Okay, you can see Bartlett Company's common stock at the end of 2015 was selling at 32.25. So let me write down here 32.25. Okay. So the market price is given for 2015 and 2014 in the table. Okay, anyway. So actually in the market ratio, you try to see in the share market how the share of the company is performing from the perspective of the shareholders. So market price per share divided by earning per share. So if the earning per share, let's say the earning per share is $2 and the market price is $10. So you can see that investors are ready to pay 5 times the current earning per share. Okay, so that is an indication how the investors see the company. What is the perception of the shareholders or investors about the company? Okay, and market to book ratio is also very important. Let's say in your balance sheet, the book value of equity is in this case it is 1954. Okay, now in the market it is different. Market price is different. Market price is not from the balance sheet of the share, balance sheet of the company. It is from the demand and supply for the share. So if the market price is double compared to the shareholders equity, then market to book ratio will be 2. Okay, this is the way we have to calculate. Okay, okay, now let us create a spreadsheet. Rename ratio. Okay, I'm giving the name ratio. Let me increase the size of the spreadsheet. So we'll create the similar table, and in your assignment, in your case study, group case study, you will also do the same thing. Okay. So let us write down type of ratio. Follow the way I'm doing. Okay. So at first we will write liquidity. Are you following me?
Yes, sir.
Yes, sir.
Yes, sir.
Okay, type of ratio is liquidity. Then you can do with me in your computer, or maybe later on you can also do while watching the class recording. Okay, so type of ratio, then the ratio itself. Okay, name of the ratio. We will use a slightly different way, formula. That will be a good reference for us. Formula. Then year, okay, 2014. 14. Actually, in this case, what you should do, you should follow the way you have done in your financial statement. In your financial statement, you have given 2015 first, then 2014. Okay, but remember when you graph it, when you graph it, usually the earlier years are on the left. Okay, so what you should do, in my opinion, actually, even when you what should I say, even when you copy the financial statements, you should keep the earlier years to the left and later years to the right. Okay, that is handy for us, right? So let us do it. And let us check if everything is okay. Yeah, I think it is okay. Let me do it for all. And what I will do, I will delete this one. Delete, shift cells left. Now it's fine, isn't it? Is it okay or not? Oh my God, my students even do not say okay or not.
Yes, sir.
Yes, sir.
You should remember that, your classroom attitude will also reflect the attitude of your university, your country, and everything. Do you understand?
Yes, sir.
Oh, what happened? Cancel. Doing the same thing. So now you will see whatever we have learned about the spreadsheet will also help us doing so many things. Shift cells left. Let us put it. Fourteen, 15, 14, 15. Just a check. FF. Now this part. I think now it's okay, right? The whole thing.
Yes, sir.
Okay, 14, 15. So now in doing the ratio analysis, what we will do, we will do it for 2014 first, 2014. Sorry, 2014 and 2015. That will be better when we do our graphs. Okay. And we'll also input the industry average. Industry average. So that will be done later. Okay, no problem. Let us calculate the ratios first. So under liquidity ratio, how many ratios do we have? We have two ratios, current ratios and quick ratio. So what is the formula of current ratio?
Current assets minus current liability.
Okay. Does Excel allow to insert equation? I don't think. Anyway, let us current asset over current liabilities. Thank you. Over current liabilities. So we need little more space. And quick ratio is equals to current asset minus inventory. So we'll use the brackets, okay? Current assets minus inventory, bracket close, divided by current liabilities. Are you doing with me?
Yes, sir.
So you can see, if we write the formula, that will help us a lot. Okay, so we have only two liquidity ratios. We can copy down now activity ratio. Activity. We have inventory turnover. Okay, I will copy from here. To make my life easy, average collection period, then average payment period, then total assets turnover. Okay, now the formula. Inventory turnover is cost of goods sold divided by inventory. Divided by inventory. And average collection period is accounts receivable divided by average sales per day. Average payment period, accounts payable divided by, so I will copy here and edit it. Accounts payable over average purchase per day. Then total asset turnover is sales over total assets. Okay, sales over total assets. Is that okay? Correct me if I have done anything wrong. Then we have debt ratio. Times interest earned ratio. Then fixed payment coverage ratio. Okay. So debt ratio is very easy. Total liabilities divided by total assets. Divided by assets. And times interest earned ratio is earning before interest and taxes. Divided by what? Can you help me? Are you listening to me?
Yes, sir.
Okay, what is fixed payment coverage ratio then? This is a bit complex, but it's okay. We can still write it here. Earning before interest and taxes plus lease payment.
Divided by interest plus lease pay.
Yeah, very big. plus lease payments. So that is the numerator, and in the denominator, probably we can use, we can go to the next line by alter enter. If you press alter enter or in Mac option enter, then it will, the remaining part will go to the next line in the same cell. Divided by what? Divided by interest plus lease pay.
Principal amount.
Yeah, we can use different brackets actually. So it will be interest. Let me write in short because so many things. Plus lease pay plus, now we have another portion, principal plus preferred dividend.
Sir, another bracket, sir.
Yeah, another bracket. Okay. So it is going to be principal repayment. Okay. Principal repayment plus preferred dividend bracket close times curly bracket. Oh, no, we have already used one. So it's going to be first bracket. Okay. 1 over another first bracket. We don't have any more. 1 minus T. Okay, T is the tax rate, remember. Bracket close and another bracket close. Then we have the curly bracket, then square bracket. Okay, so this is, we don't need to, actually we'll look at the textbook rather than looking at it because it will confuse us. Okay, it will rather confuse us if we look at the formula in the cell. Okay, anyway, so that is the debt ratio, then profitability ratio. Profitability only. So what are the profitability formulas? Ratios: gross profit margin, operating profit margin, and net profit margin. Then we also have earning per share. We have already done that actually. Earnings per share. Then return on total asset, or return on asset in short, return on assets, then return on equity. Okay. So not very difficult. Gross profit over sales. Profit over sales. Then operating profits over sales. Then earning available for common shareholders. Sometimes in other company you will find that they're just writing net income. That is also okay. Anyway, earnings available for common shareholders over sales. Then earning per share is same thing divided by number of shares, number of outstanding shares. Okay, number of shares outstanding. Then return on equity, return on asset is also the same thing, but here the denominator will be total assets. Again, this one, the denominator will be total equity, common stock equity. Total equity or common stock equity, same thing. But remember, better to write common stock equity because preferred equity will not come here. Okay. Common stock equity. Or sometimes people also just write common equity. Same thing actually. So all these are profitability ratios. Okay, now we have only market ratio remaining. So the market ratio, we have only two ratios: price earning ratio, price earnings ratio. People often call it PE ratio. Okay, this is the short name actually. Price earning ratio, and we also have market to book ratio. Market to book ratio. So how to calculate? Market price per share over earning per share. Earning per share is already calculated on above. Earning per share, and market to book ratio is market price per share divided by book value per share. Book value per share. Okay. So that is the end of. Now another thing I want to write here is the short name, the notation of the ratio. That is useful. So let us write current ratio by CR, quick ratio by QR, then inventory turnover by ITO. These are very easy to remember. Average collection period by ACP, average payment period by APP. Just giving name. Total asset turnover TATO, TATO, debt ratio DR, then times interest on ratio TIE, then fixed payment coverage ratio FPC, fixed payment coverage ratio, then gross profit margin GPM, operating profit margin OPM, net profit margin NPM, earning per share EPS, return on asset ROA, then ROE, then P/E, or some people also say PE ratio. Okay, just PE ratio. Then market to book ratio is MB. Market to book ratio. So now we will calculate all these ratios. Are you ready?
Yes, sir.
And remember that some information will be from the income statement, some information will be from the balance sheet, and some will be from other other information. So let me make it little and this one big. Okay, so the heading bold, underline. Now let us calculate. So current ratio is equal to, never type the number. You will always link the cell. Otherwise, your mark will be deducted substantially. Okay, so the current ratio is equal to current asset over current liabilities. Current asset, where is current asset? Where should it be? Income statement or balance sheet? Current asset, current liabilities, where you can
Balance
find?
sheet.
In the balance
Balance
sheet.
sheet.
All of you know, right? So current asset, where is current asset? Total current asset divided by total current liabilities. Total current liabilities. Enter. Okay, so you have got it for 2014. Let us reduce the decimal point up to 2. Then we can copy it directly to the right to get that for 2015. Let us check if it is okay. So it says that for 2015, if in the FS worksheet, F38 divided by F53, let us check. F38 total current asset divided by F53 total current asset of that year. So it's fine. Okay, so we have got it very easily. Now we will do the quick ratio. Quick ratio is equals to, you have already learned about the formula, right? We have already discussed those things a lot. So quick ratio will be current asset minus inventory divided by current liabilities. So it will be current asset. Remember, we are on in the year 2014. Okay, current asset minus inventories is there. Okay, bracket close, divided by current liabilities. So we have got it. We will do the formatting later. Let us do one by one and do the things, do the other things later. So inventory turnover is equals to cost of goods sold divided by inventory equals cost of goods sold. Where do we find the cost of goods sold? Who can tell me?
Income statement.
Income statement. Okay, so cost of goods sold is here. Okay, very easy. Divided by what? Inventory. Okay, inventory turnover. Then average collection period. So here you need the information of accounts receivable divided by average sales per day. So it is going to be equals accounts receivable definitely in the balance sheet divided by average sales per day, but we have total sales of the year. My income statement is for the whole year, so it is going to be within bracket total sales divided by number of days in a year, 365. Do you understand this?
Yes, sir.
Yes, sir.
So we have got the average collection period. Now average payment period, accounts payable divided by average purchase per day. Okay, but remember, we do not have any item. We do not have any item called purchase. We do not have any item called purchase. So how do we find purchase? So I'm going to show you why you need to read the textbook. Okay. Do you think that in the income statement or balance sheet we have a direct item called purchase? In the income statement, we don't have any purchase here. Okay. In the balance sheet also, there is no question of having purchase. So in that case, I know if we do not understand anything, we will go back to the textbook discussion and see how the textbook has indicated to find the purchase. Okay, you see, the difficulty in calculating this ratio stems from the need to find annual purchase. Okay, how do you find annual purchase? Okay, a value not available in published financial statement. Companies will not report that in the financial statement. So what to do? Ordinarily, purchases are estimated as a given percentage of cost of goods sold. Normally, what is cost of goods sold? Cost of goods sold include the cost of material, the cost of labor, cost of overhead, and all these things become big. If you total all these things, then you get cost of goods sold. So purchase is a part of cost of goods sold. So in that case, actually, if you are the insider of the company, you will be able to collect the information about purchase. But if you are the outsider, like bank or maybe analyst, stock market analyst or whatever, in that case, you will not get the information about purchase. So what you need to do, you have to make a reasonable assumption. Okay. So in the textbook, what they have done, they have assumed that the purchase is 70% of cost of goods sold. Okay. So that is the assumption, not unrealistic, realistic assumption. Okay. Depending on, you have to, you have to see what kind of product or service the company is selling, and you have to, do some kind of subjective judgment. You have to also discuss with other people to really decide, how much of this item carries the materials, what percentage of this of the cost of this production is only purchase. You have to find that. You have to assume that. It cannot, your assumption might not be exactly correct, but it will be close to the correct estimation. Okay, another thing is, it should be credit purchase, not the annual purchase. So if you are the insider of the company, you will also use only the credit purchase, because we are concerned about payment period. So if you purchase on cash, for that, there is no relevancy of payment period, because you will pay instantly. So these are the things you should remember. We might not be able to show it in the classroom setting, but when you become a manager or when you become the business owner, I have learned that many of you want to be a business owner. You have to remember that we are only actually concerned about credit purchase. But for now, we are ignoring that. We are assuming that a certain percentage of the cost of goods sold is purchase. So what we will do, at the bottom, we will write down another information. Okay. Assumed percentage of cost of goods sold annual purchases as percentage of cost of goods sold within bracket assumption. Let us write credit purchase, because we are really concerned about credit purchase. So in this case, it is 70%. 70%. So 70% is the, and the same for the next year. Okay. Now let us go and see how to find the average payment period. So average payment period will be equal to accounts payable divided by average credit purchase per day. So what is accounts payable? Accounts payable is in the balance sheet, divided by you have the 70% of cost of goods sold. That means this one times cost of, remember we are always in year 2014, times cost of goods sold is this one, divided by 365, because we have to find the average daily purchase. Okay, so this is the calculation, and we have got it. Let us go back to our table. Now again, total asset turnover, sales divided by total asset equals sales revenue divided by total asset from the balance sheet. Then again, debt ratio, total liabilities divided by total assets. Total liabilities divided by total assets. Then EBIT divided by interest. Remember, operating profit is also called EBIT. Okay, this one, let me write within bracket. EBIT, earning before interest and taxes. Okay, so times interest earned ratio is equals to EBIT divided by interest. So equal to EBIT divided by interest expense. Okay, now fixed payment coverage ratio, this is quite big, don't worry. So it will be, let us look at the textbook formula. You can see here, EBIT plus lease payment. Do we have any lease payment? So let us take the EBIT and see if we have any lease payment here. We have, okay, so this one plus lease expense, bracket close, divided by, let us go and see. No, okay. So EBIT plus lease payment is the numerator, and in the denominator, it will be within bracket interest plus lease payment. Okay, so let me delete this portion, then do it fresh. So interest expense plus lease payment plus principal repayment, we don't have here actually, so that will be 0. Okay, plus within bracket we have preferred dividend only. So the preferred dividend is here, preferred dividend times 1 over 1 minus t, times 1 over 1 minus tax rate. So what is the tax rate? Do you know? Amra ki jani? Do you know what is the tax rate?
Yes, sir.
What is the tax rate? Tell me.
91.
90?
91, sir. I mean interest section. Sorry, sir. Tax rate is 64.
Tax amount is 64, but we don't know the tax rate.
Yes.
Okay, I'm copying this formula so that later on I can paste it again. Okay, let me go out of this, and we don't have any tax information. Okay, so what we need to do, we need to collect the tax rate. That is one thing when I do it practically. And another way is, if you do not know the tax rate, you can simply divide this tax by profit before tax. Okay, then you can also get the tax rate, a rough estimation of the tax rate. But let us see in the textbook how they have done it. Probably they have given the information about tax rate to match it with the textbook example. So they have considered 29% as the tax rate. I don't know where they have got this information. Anyway, the tax rate is 29%. Okay. The tax rate is 29%. So we'll type this at the bottom. Let us calculate it in the way I have said. Let us see what we get. So the amount of tax is this one divided by this one divided by. So because the company has given $64 tax on 212, so from here we can also calculate the tax rate. You can see it is 30%. So normally if it is not given, we can do in this way. But since it is already given in the textbook, let us write down 29%. Is that okay?
Yes, sir.
So again, let me copy. Because I've already copied, so I'm pasting it. So 1 minus, we have the tax rate here. Okay, bracket close. Again, bracket close. Then enter. There was a typo, and we'll check again. 2.41. Let us check. Huh? If we find it correct with the textbook. 2.4, yeah, 2.4. Let me do it again to avoid any confusion. Okay, I'm deleting it. Now let us look at the formula in the left side here, and let us type it again. Equals, in the numerator we have EBIT plus lease payment. So let us go there. The EBIT is in the income statement, EBIT plus lease payment. Okay, bracket close, divided by, again another bracket. Let me close the bracket so that we don't have any problem. Okay, now inside the bracket I will type everything. So inside the bracket we have three terms, this one plus this one plus this one. Okay, this is actually same thing, actually together, no, not same thing, together. So interest plus lease payment. Okay, so inside we have interest plus lease payment plus some calculation. So again double bracket, and inside the bracket we will type the whole calculation. So inside we have principal repayment plus preferred dividend, but because we don't have any principal repayment right now, so we just type the link of preferred dividend. Okay, so we have the preferred dividend here. Okay, $10 times 1 over 1 minus tax rate. Okay, 1 over 1 minus tax rate. So it is going to be divided by 1 minus tax rate. Same thing. 1 over 1 minus tax rate means divided by 1 minus tax rate. So I'm just dividing it by 1 minus tax rate. Within bracket 1 minus tax rate, bracket close. Now there should not be any problem. Enter. Okay, it is done. So if you cannot follow it, you can watch the class record later on. Maybe pause and see what I'm doing. Then again play, again pause, and this is how you can practice. Okay, if you do not practice this example very well, probably you won't be able to demonstrate or present your case study during the presentation. Okay, now let us go for the profitability. Profitability ratios are quite easy. So profitability ratio is equals gross profit over sales. Very simple. Go to gross profit over sale. Enter. Then operating profit margin, operating profit over sale equal operating profit over sales revenue. Then earning available for common shareholder divided by sales. This is the net profit margin equals earning available for common shareholder divided by sales. Remember, if you don't have preferred dividend, the net profit after tax is equal to earning available to common shareholder. Okay, remember this. So we get the NPM. Then earning per share is already calculated, but still let us do it again. Earning available to common shareholder divided by number of share. So earning available for common shareholder divided by number of share. Here you can see it, number of share. So we have got it. Again, return on asset, earning available to common shareholder divided by total asset. So let us go there. This one divided by total asset. Return on equity. Again, earning available to common shareholder divided by total equity. Common shareholder divided by total equity. Where do we find total equity? Remember, it is total common shareholders equity, not the preferred shareholders equity. Okay, so here you can see we have preferred stock, common stock, and other things. So what you need to do, this equity also include preferred stock. So you have to deduct the preferred stock from here. So this is what you need to adjust. So this is this one minus the preferred stock. Then you get only common stock, because equity includes both preferred and common. So you just need to deduct the preferred. Okay, see the formula, common equity. So from total equity, you have to deduct the preferred equity to get the common equity. Now price earning ratio. So this is very easy. Market price per share divided by earning per share. So we have already got the market price per share, 18.06, divided by price divided by earning per share. Earning per share is already calculated here. So it will, you will take it from here. This is the earning per share. Okay. So one item is coming from the FS worksheet, another item is coming from this worksheet, ratio worksheet. Yes, this is the price earning ratio. Why is it so high? I have to recheck, if anything is wrong. It should not be so high. E14. Maybe there is a mistake. We'll check that later, and let us do it. First. Then we will. Auditing the spreadsheet model is also very important. After doing calculation, no matter how expert you are, no matter how novice you are, there will be mistakes, and you have to check each and every calculation. So market to book ratio is market price per share divided by book value per share. How do you do that? Market price per share divided by book value per share. So that is also important. Total equity divided by number of share. So in that case, you have to see in the similar manner, you have to find the common equity excluding the preferred equity. So that is the book value of equity. That means the balance sheet value of equity. Let us put it within bracket, divided by number of shares outstanding. So what is the number of share outstanding? What is it? Okay, number of shares outstanding. Okay, got it. So we have got the book value per share. So market value per share divided by book value per share, we get it. Now I can understand where is our mistake actually. The mistake is all these amounts are in 1,000. Remember, all these amounts are in what? In 1,000. Do you remember? Hello? Hello? Hello?
Yes, sir. Yes, sir.
Yes,
Do you
sir.
remember that all these amounts are in thousands?
Yes.
Yes, sir.
And this amount is it in 1,000? Let
No,
us
sir.
check it. Let us check. Let us go back and see. You see, they have, when they calculate the EPS, they have calculated, they have divided this number, and they have divided this number by 76,262 number of share. Okay, so 221 is not divided, 221,000. Okay, remember, So that adjustment should be done. So because we have taken all the amounts in 1000, but number of shareholder is the actual amount, no? So in the formula, we have to adjust it. In the formula, we have to adjust it. Okay. So let us see where we have used the shareholder number of shareholders for the first time. So can you tell me in which place we have used the number of shareholder for the first time in all this formula?
EPS.
And yeah, so not in current, not in liquidity ratio, not in activity ratio, not in debt ratio, but we have used in profitability. Yeah, you are right, in the EPS. So in the EPS, in the formula, we can see we have used E18 divided by, in the other worksheet, E18 divided by E22. So E18 contains the number in thousands and E22, right? Number of outstanding share. So if the bottom one is divided by 1000, the top one is divided by 1000, this one should also be divided by 1000. Then it will be okay. You can also do other way around. You can multiply the numerator by 1000, same thing. Now it should be corrected. 1.8. Let us see if we have used any other number of common shareholder. Not here, not here. This is the amount of equity, not the number. Market price per share, also no number. So only one, in only one place we had this issue. But in book value per share, we also have that issue, because in book value per share, we have used the value of E22. So we have to divide that by 1000. Then it will be corrected. Okay. Now I think it should be correct. So what we will do, we will try to see if our result matches with the textbook result. We might have a slight difference, because in some cases they have taken the rounding, they have rounded the results. Let us reduce the decimal points to see it in a better way. Okay, now please match what we have got for the year 2014, because we have done it for 2014 actually. Can you check? Tell me if current ratio and quick ratio matches. Does it match? Students, are you in the class?
Yes, sir.
Yes, sir.
Yes, sir.
Matching or not? Tell me.
No, sir.
Tell me if liability is okay. Okay, everyone, please switch on your camera. I'm thinking to give you class participation marks. Whoever responds more will get bonus. So please tell me if the liabilities are matching. You have already said that it is matching. Now compare the activity ratio of 2014 with the activity ratio we have calculated here. These are the activity ratios. Okay, these four. Can you check if these four are matching or not? (2014) value 5.7.
Sir, is there matching, sir? They're
9,
matching.
it doesn't match. 81.2, it matches. Then 0.79 matches. So only problem is this one. I think that is also not a big difference, but we'll still check. Let us keep it in yellow. Now we'll check the debt ratios. If the debt ratios matches, tell me. 44.3. Is it matching?
Yes, sir, it is.
1.4. Now,
Yes, sir, they're matching, sir.
Only 1.4 isn't, sir.
fixed payment coverage ratio doesn't match, right?
Yes, sir, fixed payment coverage ratio doesn't match.
Okay. Then profitability ratios. We will see the reason why they are not matching. So 33%, 11.8, okay, 5.4, okay, 1.8, okay, 4.2% also okay, 8.5% means 9% also okay. And the last two, 10% and 0.85. So only problem that we have here is with the fixed payment coverage ratio and the average collection period. So we'll look at it within the textbook. Let us go back to the average collection period and see why our calculation is different. Average collection period. Average collection period. Okay, they have done it for 2015, but no worries. We will check it for 2014. We will just look at the way they have done it. So this is actually what we are doing. It is arrived at by dividing the average daily sales into the accounts receivable balance. So accounts receivable is taken. Let us check if we have taken it correctly. E36. Let us check if E36 is the accounts receivable. Yeah, accounts receivable 365. No problem with that. Let us check if we have typed the value correctly. Yeah, accounts receivable, right? Can you see what is the accounts receivable 2014? 365, correct. Average collection period, okay. And then divided by annual sales divided by 365. So what we have done here, we have divided by we are supposed to do annual sales divided by 365. So E4 divided by 365, E4. Yeah, E4 is the sales revenue divided by 365. So our calculation is correct. Okay, now just let us see what is the sales revenue here, just to check if the amounts are correct. Balance sheet, income statement. 2567, it is correct. Okay, so no worries. The textbook might have the typing mistake also, or it can be due to any rounding problem, but we have not done any rounding because Excel doesn't round. Okay, so our calculation is correct. We can be confident with that. Do you understand? No fail. Okay.
Yes, sir, a doubt, sir.
Yes.
Sir, can you tell that last market book ratio once again?
Market, sorry?
Market book ratio.
Okay, we will go to that, but before that, let us look at the fixed payment coverage ratio, if it is okay.
Okay, sir.
Okay, because we can see a very big difference here. So fixed payment coverage ratio is, let us see what they have done here. We might have a problem with the calculation because we have said that there is no principal or something like that. But remember, in the calculation, you can see principal payment 71,000. So how did they get this 71,000? That is an issue. We have to look at it. So probably we have to include the amount of debt. Let me check. in the financial statement. Oh, okay. To adjust the after-tax principal and preferred stock dividend payments back to a before-tax equivalent. Well, there is something in this principal amount. Do you remember that we have said that this amount will be zero, so we'll only use the preferred dividend. Okay, but we don't see any explanation why this 71,000 is there. So please remind me. Okay, Pradeep, you are responsible. Okay, in the next class,
Yes, sir.
can you remind me that I wanted to give an explanation or I wanted to correct the calculation of fixed payment coverage ratio. Can you help me?
Yes, sir, definitely.
Please remind me in the next class. Okay.
Yes.
Right now I cannot give the explanation. I'm not ready for that. Anyway, so let us keep it yellow so that we also have a look here. So what is your question? Market to book, right?
Yes, sir.
Okay. So let us look at the formula of market to book first. The market to book ratio is equal to market price per share divided by book value per share. So you have to understand what is book value. Okay, book value means actually this is the book value of share, book value of equity. Okay, so book value of equity is basically, book means the accounting book, that means balance sheet, income statement, and all these things. So you have to see what is the value of equity, common equity, in the accounting book, that means in the balance sheet. Okay, so in the balance sheet you can see the total equity is 1820, but out of that 200 is preferred stock. So ultimately, what is the common equity? 1820 minus 200. Have you understood that?
Yes, sir.
So that is the thing you have to remember. Okay, so in this formula, if we look in the formula bar, the top portion, the numerator is market price per share, taken from here, market price per share. Okay, now the next part is the book value per share. So how did you get that? We have taken this E60, that means the total equity, this one, minus E56 preferred stock. You see, E56 minus. So from in this part, we have got the common equity in the balance sheet. Have you got it?
Yes, sir.
Now that is the total common equity. Now you have to find book value per share. Okay, book value of common equity per share. So you have to divide by what? Divide by the number of share. So where do we get the number of share? E22. If you go here, E22, you can see the number of share. But remember, our income statement and balance sheet amounts are in thousands, but this is actual amount. To match these two, we have to divide it by 1000. Okay, so this is why we have divided it by 1000.
Thank you, sir.
Got it? Okay, now we can very easily calculate that for 2015. Just copy, because we have made sure that every items are consistently in the next cell. Every items of 2015 are in the next in the following cell to the right, to the right. Yeah. Okay. Is that okay?
Yes, sir.
So now we can go for a break. Do you want a break or not?
Yes, sir.
Okay, we can go for a break and we will come back after roughly after 15 minutes. Thank you very much.
Thank you, sir.
Yes, sir.
Okay, now what we will do, we have already calculated the ratios. Oh, by the way, actually, the fixed payment coverage ratio, let me clarify this one. We don't need to wait for the next class. Actually, we are supposed to keep the principal repayment here. In this formula, we are supposed to keep the principal repayment in this portion. Okay, in this portion. But the problem is, since we are the outsider of the Bartlett company, we do not really know how much is the principal repayment. If you look at the balance sheet, the long-term debt is the debt from where we actually repay the principal, right? And in 2014, the debt or the loan, whatever you say, was 967. Okay. And in 2015, it has increased to 1023. How does that increase? It might be due to new debt. Okay, new debt, new loan from the bank or new bond, whatever you say. But not only the new debt, you know that every year companies will also repay the old debt. Okay, so repay of old debt. So ultimately what will happen, it will be something like this. The debt in 2015 will be equal to something like this. Debt in 2014 plus new debt minus repayment of old debt, right? So this will be something like that. So new debt will be equal to the debt in 2015 will be the debt in 2015, this amount will be equal to debt in 2014 plus any new debt by this 1 year time the company might have taken a new loan. And also by that time the company might have repaid some of the loan. So in the formula, we have to take this portion, repayment of old debt. But it is not possible to find that from the financial statement. You have to have access to further information. Or maybe if you download the annual report, in the annual report, the financial statement also has a note at the end of the financial statement. So from there you can get the detailed information. Okay, so from this textbook financial statement, we don't have the information, but they have mentioned in their calculation that it is 71,000. The company has repaid all debt by the amount of 71,000. Okay, so we just can write here. Maybe we can consider it as an extra information. Okay, repayment of old debt or principal repayment. To understand it better. Are you listening to me?
Yes, sir.
Principal repayment of old debt. In 2015, it is 71,000 as per the textbook. But we don't know what is the amount in 2014. That has not been mentioned. Okay, that has not been mentioned. Anyway, just consider it equal. And let's see, later on we can adjust. So in this calculation, here, we have to add the debt repayment. Plus now the result should be closer. Debt repayment. .0045. Oh, it is even worse. Let me check. 77 is 17. Interest plus lease payment plus within bracket principal repayment plus preferred dividend divided by one minus tax rate is 75. I think the formula is okay. So let us consider that the assumed is the amount of debt payment. So if it is that, then we can see very clearly see that the formula is okay. So that is the result of a fixed payment coverage ratio. That is the result of fixed payment coverage ratio. You know what? We also need to remember that the preferred dividend amount in the balance sheet. What is the preferred dividend amount in the balance sheet? Can you see and tell me preferred dividend? It should be in the income statement. Sorry. What is the preferred stock dividend? How much is the preferred stock dividend?
10, sir.
10 or 10,000? 10 or 10,000?
10,000, sir. 10,000.
10,000. Okay. So here the figures are in thousands, but here the figure is in total. Again, we have got the same problem. So you have to divide it by by 1,000 actually. So this amount should again be divided by 1,000. Then we will get it correct. So this one divided by 1,000. Now it becomes meaningful. So actually, what is the issue? We had actually two issues. One is we have not included the principal repayment because it is not mentioned here. But later on, we find that we have to actually collect the information of principal repayment, which is not available. So we have assumed that every year the company is repaying 71,000. Okay, done. And again, we have to remember in the balance sheet and income statement, all amounts exclude the last three zeros. But here we have written the full amount. Okay, so that is the thing we have to adjust in the formula. So in the formula, with this amount, we have divided by 1,000 so that it resembles the way we have used the values here. Okay, So now we have got that our fixed payment coverage ratio is, it will not match with the textbook because in the textbook they have different assumption. Here we have different assumption. Okay. So let us keep it marked to indicate that it might not match with the textbook. Is that okay? Any question?
Yes, sir. So, sir, return on equity, can you expand it once again?
Sorry,
Return on equity.
return on equity.
Yes, sir.
Okay, return on equity is, if you look at the formula here, earning available for common stockholder divided by common stock equity. Okay, so earning available for common stockholder is in the income statement. This one is E18. Okay, E18. So we have done that in the numerator E18, but we have to divide it by common equity, common stock equity, right? But the problem is in the balance sheet, we do not have common stock equity only. In the balance sheet, we have total equity, which also include preferred equity. Preferred equity is different from common equity. So we have to deduct that to get the common equity. If you don't have any preferred equity, you can take the total, no problem. But because you have the preferred equity, you have to deduct the preferred equity from the total equity, then you will get the common equity. So this is what we have done. E60 minus E56. Okay, so you can see here E60 minus E56. Got it?
Yes, sir. Thank you, sir.
Any other question? Okay. Now let us collect the information about the industry average. It is already given here. So we will just copy the industry average ratios and then we will compare. So for making it easier, let me hide these two columns. Later on, I can definitely unhide, no problem with that. So industry average. Industry average. It is given here directly. Industry average of 2015, right? So what I will do, I will write in short. So let us type the values. 2.05, then 1.43, 6.6, 44.3, 66.5, then 0.75, then debt ratio 40%, 0.40, then 4.3, 1.5, 4.3, 1.5, then 30%, 0.3, 0.11, 6.2%, that means 0.062, 2.26, okay, 2.26, 4.6, 0.046, 0.085, 0.085, then 12.5, and then 1.3. Okay. Now remember, we have to, to make it consistent with the practice. For some ratio, we will just keep the whole number. For some ratio, we'll show it in terms of percentage. For some ratio, we'll keep the decimal. For example, debt ratio. If you look at the textbook, which one they use the percentage? Remember, the debt ratios are in percentage. The debt ratios are in percentage. And another thing is period. These are in days, but I'm not going to write days here because we need some comparison, some calculation, some formula. So if we write days, then it will be difficult to employ the formula. But let us convert the debt ratios in percentage and also profitability ratios in percentage. But not necessarily you have to do that. That will look the things better. Only that thing. So debt ratios in percentage with 2 decimal.
Excuse me, sir.
Excluding the times interest earned. Yeah.
Sir, how can we calculate the industry average?
That is not a calculation, that is given. Actually, in real world, you will have to collect the average of the industry.
Okay.
So if you know that these ratios of different companies in the industry, then you can take the average. Okay.
Yeah, okay, sir, I got it.
So debt ratio is in percentage. Okay. Times interest earned ratio and fixed payment coverage ratio, keep it as it is. Then these 3 in percentage with 2 decimal points. Earning per share is simple number. Then return on asset and return on equity is usually mentioned in percentage term. Then price earning and market to book ratio are kept as it is. Now let us compare. There are 2 types of analysis. One is the cross-section analysis. Cross-section analysis means you compare the result of 2 in the same time, at the same time. For example, if you compare the 2015 current ratio with the current ratio of the same year of other company or the industry, then it is cross-sectional comparison. Okay, then it is called cross-sectional comparison. So let us write down cross-section analysis, but I'm not writing the full thing. Cross-sectional analysis or cross-sectional analysis, cross-section analysis. And the time series analysis is the analysis over time. Time series analysis is the analysis over time. That means comparing the result of the same company over time. For example, 2014 versus 2015. Okay, that is called time series analysis. Understood or not? Have you understood?
Yes, sir.
Okay. So now let us do the cross-sectional analysis. Okay. If you want to do the cross-sectional analysis, you have to know which ratio should be, the ratio, should the ratio be higher to be treated as good or not? Whether higher is better or lower is better, you have to know that. Okay. So you can do it merely by looking at the ratio and comparing it. For example, if you look at the current ratio, the industry average is 2.05, but current ratio is 1.97. So is it good or bad? No. Normally, we will say that it is okay because it is close to the industry average. 2.05 is also very close to 2. 1.97 is also very close to 2. Similarly, quick ratio, it is 1. So normally we can do it subjectively. But if we want to employ the Excel tool, then at first we have to decide the comparison criteria. Okay. Only criteria is okay. So what is the criteria? What is the decision criteria to conclude whether it is good or bad? So we have to know that first. So for current ratio and quick ratio, it should be close to the industry average. That is the criteria. Should not be much deviated from the industry average. Do you understand? Do you understand or not?
Yes, sir.
It should not be much deviated from the industry average. So how much deviated? If you want to employ the Excel tool, then you also have to decide how much difference is acceptable. How much difference is acceptable? Let's say within let's say within 20%, not 20%. Yeah, we can decide, no problem, within 20% of industry average, of IA for industry average. And quick ratio also same. Then inventory turnover. What is the decision? The more is the turnover, the better. Higher, the better. Are you understanding this? Average collection period. Tell me what should be the criteria?
Should be
Higher?
low. Should be higher, sir.
No, should be lower. You have to collect as quick as possible. Thank you for your answer. Okay. The less, or we can just use lower. The lower, the better, because you are collecting other people's money. But average payment period is different. The higher, the better. You want to delay payment of other people, right? Total asset turnover, the higher the better. Then debt ratio. This is also within. Let us consider 20% in this case as well. Within 20, no, it should not be 20%. It should be 10% of industry average times interest earned ratio. The higher the better. Fixed payment coverage ratio, again, the higher the better. Gross profit margin, the higher the better. Operating profit margin, the higher the better. Net profit margin, the higher the better. Earning per share, the return on asset, the higher the better. Return on equity, the higher the better. Price earning ratio. Price earning ratio should be higher, because higher price earning ratio means investors are ready to pay high price compared to the earning per share. So the higher the better. Actually, it depends on who is using the information. Market to book ratio, also the higher the better, because if the market price is higher, that means the company is performing better. The company has very high growth potential, and this is why people are ready to pay more price for the share in the market. Okay, now we will do the comparison.
Sir, doubt.
Yes.
Sir, what is the case of average age of inventory?
Sorry.
Average age of inventory.
Average age of inventory. We have not included. Actually, there are so many other ratios as well. We are just covering the basics.
Okay.
You can definitely calculate the average age of inventory. That is also possible to calculate.
Yes.
If you divide 365 days by the inventory turnover, then you will get the average age of inventory. Do you understand?
Yes.
So you can do that very easily. So we are just showing the examples, and you can definitely apply that for. So these are actually let us do two types of criteria, time series criteria and cross-section criteria. So for cross-section, we always need to compare it with industry. Let me copy it so that I can adjust for time series as well. Okay. So actually, in cross-section criteria, we have to our criteria should be something like comparison with the industry average, right? So these two are okay, but this one, just don't just say that the higher the better. We should say higher than the industry average, higher than the industry average in AVG. The higher than the industry average, the better. This is how we can write. Is it okay? This one is lower. So I'm just adjusting, making it better. All are the same. Okay, now we will make the cross-sectional comparison. So for doing the cross-sectional comparison, now we will apply the logical formula. So you already have learned it. If 2000, we will do for 2015 only. We will compare 2015 of our company with the industry. So we will test whether this value is within 20% of the industry average or not. Okay. So what we will do at first, let us see what is the deviation. What is the deviation? So the deviation is industry average minus our company result. And we don't want it to be a deviate in both direction, positive or negative. This is why we have another function called ABS. That means absolute value. Okay, absolute value of this difference. Okay, absolute value of this difference. Okay, absolute value of this difference divided by industry. Divided by industry average. What is industry average? This one. Then we will get the absolute value of the percentage. So this is the do you understand? This is the percentage of deviation. It should not be greater than 20%. So if it is greater than 20%, if it is greater than 0.20, then we can write poor. Else we will write okay. And the text should always be within quotation. Otherwise, the result will be okay. Bracket close. So it is within 20%. This is why we have got the result okay. Oppo, আমি ক্লাসে আছি, একটু পরে কল ব্যাক করি। হ্যাঁ, ক্লাসে আছে, পরে কল ব্যাক করি। Have you got it? Have you understood or not? We can just copy down because same criteria. Let's say here the criteria is 10%. Then what we will do? We will adjust here 0.1. Okay. Any question? Any question?
No, sir.
No. Okay. Now again, because we have the similar one here, it should be within 10% of industry average. So let me copy the formula, Control C, then Control V. Okay, now we have to adjust because it should be within 10%, so it is 0.1. Okay, now it is, you see it is poor. Why? Because the company has 45%, 45%, whereas the industry has 40%. So you can see it is beyond 10% above. Okay, so it is showing poor. Or sometimes we can also adjust the formula in this manner. We can, instead of writing poor, we can write need to approach industry average, IA for industry average. Okay, so this can also be, whatever you like, you can write there, and then again copy and paste. Now it is okay because the criteria is 20%. If we put it 10%, then it will become need to approach industry average, something like that. Okay, we don't have the similar criteria anywhere here. Okay, now we need another logical argument. It should be higher than the industry average. The higher than the industry average, the better. So the formula will be, if this is very simple, if our company's value is greater than the industry average. Have you learned these things in the class or not? The if and nested if.
Yes, sir.
We have learned, right? Okay, so I'm not going to the detail. So even though I'm saying I'm not going to the detail, actually I'm giving you all the details. So if F4, that means our result is greater than the industry, we have said that the higher the better. So we can say this is the logical test. If the test is satisfied, then the result is good. Okay, otherwise poor, something like that. Bracket close, enter. So we can, we can copy this formula for every item where the higher the better, where the criteria is higher the better. All are higher than better. Control V. So we can see that all are good except this one, because in this case, the industry, our result is less than the industry average, price earning ratio. Otherwise, you can check, in all cases, we are performing better than the industry. Can you check it? Okay. Now we have another one where we need to be lower than the industry. So we can just paste the formula and then adjust it. Okay, so in this case, instead of greater than sign, we will put less than sign. Okay, so because our result is greater than the industry, so it is poor, because it should be lower. Do you understand or not? Do you understand or not?
Yes, sir.
Okay, so that is how you can do the cross-sectional comparison. You not necessarily you have to use the same format. You can do it in a different other manner. Nobody will stop you. Okay, then let us decide the time series criteria. Time series means analyzing over time. For example, in our case, we will do it like this. We'll compare the result of 2014 and 2015. So in that case, the criteria will be actually in case of liquidity, when we do the time series comparison, we just see whether it is improving or not. For making a conclusion about the liquidity ratio, you definitely need the cross-section comparison. But because we are separating these two, we'll just say the higher the better. No. We can do it like this. Okay, it's fine. So again here, okay, so here it will be very easy. Time series equals, what we will do? We will try to compare the results of 2014 and 15. So because it is saying that higher the better, so we'll see if 2015 result is greater than 2014, then improved. We can write improved. Otherwise not improved. Okay, so we can just copy this formula by double clicking, and then we can correct wherever we have the lower. So here just change the sign, less than. Okay, lower. Oh, only one. Only for only one ratio we need to have lower value. So you can see that we have the our two ratios are not improving. One is the average collection period, and another one is the gross profit margin. These two, gross profit margin and the average collection period, these two are not improving. These two are not improving. And also we have problem with, from the cross-sectional analysis, we have problem with debt ratio, because it is need to approach industry average. So let us mark the problems, problem area. Let me unhide the hidden. So the problem is with, from the cross-sectional analysis, okay, from the cross-section analysis, we can see that we have problem with the average collection period. So let us put it within shade. Average collection period has got problem based on the cross-section analysis. Then what else? The debt ratio has got problem based on the cross-sectional analysis. The price earning ratio has got problem based on the cross-sectional analysis. And based on the time series analysis, we can identify problem in the current ratio. Let us use a little bit different color so that we can identify which one is time series and which one is cross-section. Then we can see problem with the average collection period. This is overlapping. It is confirmed by both. So probably we can use a darker, something like maybe red color border or something like that. More borders, line color red, and also thick, and also outline. Okay, so you can see it is confirmed by both cross-section and time series analysis that it has got problem. Okay, then what problem we have? We have problem with the gross profit margin. So this is another one. Okay, so from the analysis you can see that we can easily find out the scope of improvement for our company. So where are the scope of improvement? Number one, average collection period. We are not collecting quickly. The customers are paying late. That is not good for our company. For example, on an average in the industry, other companies on an average collect in 44 days, but we are collecting in 59 days. Not only that, it is deteriorating. In the last year, it was 51 days, and instead of improving, we are actually deteriorating in terms of collecting the customers' money. That is one very important area of improvement. Okay, not only that, let us go to current ratio. Although the time series comparison is saying that it is not improved, but I think it is okay, because it should be close to the industry average. Cross-sectional analysis is actually indicating that it is very close to industry average. So it's okay. It does not have any problem, but we have to keep an eye so that it does not go further down, because it is going down over time. From 2.08, it has gone down to 1.97, and we have to make sure that it remains here. It does not go down further. Okay, that is one we have to be careful. Now let us think about debt ratio. In the debt ratio, well, industry in our industry on an average, the debt ratio is 40%, but we are above that. Not only that, we are increasing further above over time. Okay, so we need the attention, although it has improved, but because it is beyond the industry average, so actually we should not go further. So again, we have to be careful. We should not increase our debt further. Another thing is the gross profit margin. So gross profit margin, we can see from cross-sectional comparison, it is higher than the industry average. But if we look at over time, it is actually decreasing. So we have to keep one eye. We have to notice, we have to see what is the problem. We have to make sure that in future we are not going to encounter any downfall. We have to be careful about that. Okay, now price earning ratio, this is the market perception. You can see on an average in the industry, the shareholders will give 12 times your earning per share. But for our company, they will give 11.13 times earning per share, which is quite lower. But we should be happy because it is improving over time. In the last year, it was 9.98. Now it is 11.13. So it is improving, and we have to maintain the improvement. Okay. So not all conclusion can be made merely by formula or function. You also need that subjective judgment. So what you can do, you can write down these comments, overall comments here. Perhaps when you listen to my lecture again, the recorded lecture, because I have explained everything, and this worksheet will also be shared, so you can keep those things written here, the overall comments. Because it will be sentence, let me keep bigger space. What happened? Why is it not accepting the bottom border? Yeah, okay. So have you understood all this thing? Hello?
Yes,
Yes,
sir.
sir. Yes, sir.
Okay, that's great. So now what we need to be careful about is we are going to submit similar case study. I will give you a case study in our Google Drive. We have a Google Drive, right? Let me show you. We have a Google Drive link distributed to you. Something like this one, right? Have you seen this one or not?
Yes, sir. Yes, sir.
So here I'm creating a new folder. As per your syllabus or course outline, you have seen that you will be solving a case in the spreadsheet. Okay, so I'm giving the name student. Spreadsheet case solution, not case solution, case study. Okay, great. So you have got one folder here. In this folder, we will have 3 cases. So this is case 1. Financial statement analysis in Excel. Great. Okay, not only that, you will also get the group for the case study. Already created the group. Let me show you in which group you are actually. So you can see your name. This is the group members list. Group name actually. Group A, B, C, D, E, F, G, H. So many groups. And you have, these are the members of group A. Do you understand? These are the members of group A. You will work together.
Yes, sir.
Okay. These are the members of group B. You will work together. So what you can do after getting the assigned case, you can have a meeting, online meeting, which in whatever platform you like to have your meeting, that is up to you. Okay, and also keep the meeting records, the attendance of the group meeting, so that I can also do some kind of marking on the group attendance. Okay, group members should attend the group meeting. Do you understand or not? So you will
Yes,
have
sir.
to submit. You will have to submit the group attendance with the assignment. I will give you all the instruction. I will give you all the instruction. Okay. And also, when you attend the group meeting, normally in which platform do you like to have your group meeting?
Sir, actually, many of us are on board campus, so I think we'll have physical meetings, few.
Okay, so if you have a physical meeting, you can also have an attendance, maybe signed attendance or whatever. If you have a Zoom meeting, you can get the attendance from there as well. So that is not going to be a problem. So you will have to submit the number of meetings and attendance of each student with the submission. I will give you instruction how to do that. Don't worry about that. Okay.
Sir, excuse me.
Yes, please.
Sir, there's a Shriman. Actually, my name is mentioned on the list.
But I have got this list from the university. What is your name?
Shriman, sir.
Sriman. S-H or S?
S-R-I-M-A-N.
Hey, here is Sriram.
Oh. No, sir. It's Shriman. S-R-I-M-A.
Is it you or not?
No, sir.
S-I, right?
S-R.
Can you type your name in the chat box? Sriman. Okay. S-R-I.
Oh.
Have you got it?
Sir, actually, Shriman's my first name and Mutagala is my last.
Okay. Have you found your name or not?
Yes, sir. I think I found it. I think it's down. It's down. Oh.
Your name is not there.
Your name is there in group D.
Whose name?
Shriman's name, sir.
D. Group D.
Yes, sir.
Kevin, Krishna, Akshara.
Yeah. It's number 27.
Oh, it is your last name actually. So what about Khushi Rawal? Have you found your name?
Sir.
So I took a lateral admission, sir.
Okay, Khushi Rawal, right?
Yes, sir.
So you can be added with okay. Can you submit your username and all this thing? Have you got all this thing? Email, username, and this thing?
Yes, sir.
Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So you can be added in group A. Okay.
Okay, sir.
So group A students, please add her name. Any other student?
Sir.
Can you scroll down?
Actually, you can also go to the Google Drive and you can see by yourself. What is your name? Khushi?
Raval, R-A-W-A-L, last name.
The last name is
Oh.
R-A-W-A-L. Okay,
And,
I do not have other information. Please give me the other information
Yes,
in
sir, I'm typing in the chat box.
to my email, not the chat box, not to my email. I have given my email
Yes.
other contact in the syllabus.
and sir,
Yeah.
one more thing. Shriman is my first name, not my last name.
Okay, that is that is what I have got from the university. You know, you can try to match the username
Okay.
or whatever email address. You know, try to make sure that it is corrected.
Okay.
So, is your email address is your email address functioning? This email address, are you using it or not? The university email address, are you using this email address or not?
Sir, we are using, sir.
Are you using this email address or not?
Yes, sir, we are using. We are using it.
You are frequently communicated from the university, right?
Yes,
so,
sir.
so I might also send the, actually, I will always give you the group assignment here, definitely here, inside the case one. I have not given anything yet, but I will give you the instruction and the case here, and you will have to follow the instruction to solve the case and submit, you know, how to submit and everything. Okay, and how to submit the group members meeting attendance. Okay, and what will be the other procedures. I will give everything here. That you will find that here, but I might also send you through these emails, because I can just copy it and paste in the email composer box, and then I can send it. Okay.
Yes, sir.
So wait for the case study and expect the deadline to be, because the case study will be similar to what we have done today and in the last class.
Yes, sir.
Today and in the last class. Okay.
Yes,
so what you can do, you can review the last class and today's class, and also if you need different other things, like for example, we have used the if function today. So if function has been discussed in another class. So you can review any class you need, because all are given in the WhatsApp group as well as in our Google Drive folder. Probably you can find it here. Probably you will find here, you know, class lecture recorded video. If you click here, then you will find all the links, you know, all classes are, the links to all classes are given here. If you click here, you should get the link. And if you go to that link, you will get the recording of the class. Okay. So I think that's the problem. So expect the deadline of submission to be Tuesday. That means today is 15 September. So Tuesday is going to be what? 21st September. Okay. And your presentation will be on 22nd. Do you understand or not? In the next class, you will be asked to show, for example, let me show you. For example, here you have calculated, let's say this is your group's file. Now I might call anyone of your group or all of your group, you know, and let's say I have called Sriram, and I have asked him, okay, share your file on the screen. Okay, he will share the file on the screen, and I will tell him, okay, delete the market to book ratio of 2014. So he will delete it. Now I will tell him, okay, do it again. So he will have to do it again. Not only do, he will also say, like me, you know, I'm calculating the market to book ratio. So because the market to book ratio is in this sheet, so let me do it equal. Then you know, you will also describe what you are doing. This is how I will test your compatibility. But if anybody fails to attend, the demonstration or remain absent in the class, or cannot, you know, if you cannot show, if you make mistake, that is okay. You know, you might lose a very few marks. But if you are totally absent, or if you do not, if you say that cannot do it fully, or if you fail to show all these things, then probably your mark will be deducted to a greater extent. Do you understand or not?
Yes, sir.
Okay. So I think I have made everything clear. And this case study will carry 20 marks, and that is a very big amount of marks. So be very serious and start working from, as soon as you get the case study, start working. Actually, you should start working from today. Today, you review the lecture again and again and get ready for the case study. By tomorrow, I expect you to give the case study. So from tomorrow, you start doing it. Do not wait for the 11th hour or 10th hour or 9th hour. Do it, start doing it right tomorrow whenever you get the case study. Okay. Otherwise, you will face problem. And also, the group members should make sure that other group members are doing it correctly. For example, if you do it, you share it with others. Or what you can do, the group members can share the activity. For example, one group member can do 2 ratio, another group member can do 2 ratio or 3 ratios, depending on the number of members in your group. So you can divide the work. That is one way. Or what you can do, you can do it together. You can sit in the meeting and do it together in the same file. Do you understand me? Do you understand me or not?
Yes, sir.
But make sure that every group member is competent to show any of the calculation. If I say, well, delete this one and do it again, then you have to be able to do that. If the group member cannot do that, that is a discredit for the whole group. So whole group will also have some kind of penalty. Okay, and individually the member will also have a greater the individual student will also have a greater penalty. Okay. So that's all for today. I hope that you will perform very well in the next presentation, in the next class, and also do the case solution very well.
Sir, when you share the case, sir?
Sorry, when I
share the case?
Yeah, tomorrow.
Okay, sir. Thank you.
So
sir.
by today, try to recreate the thing that I have done in the class, and then you will be ready for the new case, similar case. Okay. So my suggestion is do the case solution that I have done in the class by yourself. Have yourself ready. Okay, and then in the next class tomorrow, when you get the new case, it will be easier for you to solve. Is the class representative present in the class?
Sir, no, sir. I mean,
Hello?
No, sir.
The class representative is not in the class.
sir, can I be your TA? I mean,
You want to be what?
Excuse me, sir.
teaching assistant, sir.
Teaching assistant.
Yes, sir.
I don't know what is the process of being a TA. Do you want to be TA or class representative?
I want to be a teaching assistant for your subject, sir. If you're
Okay, if you want to be a teaching assistant, actually, I'm not a full-time teacher of your university.
yes,
I'm
sir.
teaching you from overseas, so I do not know what is the procedure. You can talk to your university if you want to be, then how you can be or what should be the quality.
Yes, sir. Yes, sir.
Okay.
Yes, sir.
You can talk to them. You can also talk to Dr. Debodut.
Yes.
Do you know him?
Yes, sir. Yes, sir.
So you can talk to him.
Yes, sir.
Okay. So that's all for today. Anything you want to say?
No, sir.
Okay. Thank you very much. See you in the next.
Thank you, sir.